Hello everybody, welcome to the Dashboard series. It's a short of videos in which our intention is for you to maximize the return of your investment by understanding better all the moving parts of the system. In this video in particular, we're going to talk about the past. Due to the trades that we placed in the past, now we can see that there's an option drag here and a price drag. What an option drag is something that we're going to explain separately in an independent video. Price drag is the difference between the price now of all the shares that we have minus the price that we paid for all the shares that we have. Here on the right hand side we have a value which is the account value without the drag, meaning once all the options mature and this money gets into the account value as it is now, and the shares go back to break even, which is adding up the price drag, the account would be, in this case, 1,488,000. In this table here, we can see the price that we have paid for the shares in the past, the moment that they were put to us. It's here under average open price. The income that we've gotten on each one of these stocks. It could be put income or call income. We can also see what's the amount of money that we have invested up until today in buying these stocks. In this little table here, we have a summary of all the income that we have received so far and all the costs that we have incurred in so far. Income, we have put income, call income, adding both together, we had options income. We also have dividends from the shares that do pay dividends. And this margin is the interest earned on the cash that we have in the account. Adding options, dividends, and margin, we come with a total figure, in this case, of 480,000. As for the costs, we have margin. If we use the line of credit that the broker offers to us, bank fees are charged whenever money is transferred in or out of the account. Software, it would only be charged if we place less than 2 trades per month, otherwise it's for free. Statements, as long as we ordered our statements by email, we'll get charged nothing. Adding all these costs, we have here that in this account so far we've spent $10. This table here summarizes the whole history of each one of the companies that we have placed trades on up until now. Let's go through each one of the different examples. Let's start with AEIS. We have put income that we have received for selling some puts on this stock. And we can see here at the very right hand side that that this position is open, meaning that it's a sell to open position. We have a naked put on this company. The next example that we're going to study is this one, for instance, AEO. We have received put income, total option income is equals to the put, there's no calls, and there's nothing here, meaning that there's no put open in this position. We sold the put, it expired worthless, we got to keep the income, and that was it. Another example, AL. We pay 35.01 for this stock. It was put to us at 35. The 01 is because of the commissions. We got put income before the shares were put to us, and the amount per share that we got was 6.47 on an investment of $35, which means 18.48. We don't currently own any put position on this stock. ALKS, we own the stock. It was put to us at 20. We paid 20.01 because of the commissions. We got some put income. How much? 5.41 in an investment of 20, which is 27%. There is an open put on this stock as well. ANF, we got the shares put to us at 12. We sold them at, let's say, 11, rounding it up. Therefore, we were down $1, 103, because we bought them at a higher price that we sold them. How much did we lose in this buying and selling? 9% in dollars, 720. We collected, however, call income on these shares and also put income. In total, how much? This in cash, 6,125, but Per share, 8.75 on an investment of 12. Therefore, we got 73 nearly percent on these trades. In cash, the profit was 5,405. So even though we sold at a loss, we came out of all these trades with a profit of $5,400. APOG, another different example. We got some put income on this stock, and now we have here the put option that we have open is not a sell to open position like these ones that we saw before. This is a buy to open position. This is a lead. The rest of the examples that we have from here down, from ATH down, they are all repetitions of this first 6 cases that we have here. This table is showing us the monthly summary of what has happened in the account of consideration. On the left, we have the month and the year. The 5th month would be May, 6th would be June, 7th would be July, and so on and so forth. First month, May 2020, in this particular case, we got 100,000 of put income. Let's remember that it was on an investment of 500,000. Now call income, we didn't receive any call income until the 4th month, which it was in August. Total options is puts and calls. The 3 first months, it was all in puts. Margin cost in this case is positive because it's the money that we received each month for having money in the account. It's the dividends paid on the money that we have. Bank, we only paid when there was this second transfer made. Buying and selling is buying and selling shares. Month 2, we bought shares. Month 3, we bought shares, and every month we bought shares. And in total, as we saw before, we've invested $686,000 in buying shares. We sold in September, we sold $70,177 worth of stock. Since September, we have received both September and October some dividends. Some shares pay dividends, some don't. On call income, we received it. We sold some calls. We started selling calls in August. We made positive incoming calls in August, negative in September, and in October, again positive. Why would this be negative? Because the sell to open, if we add up all the premiums that we got minus all the premiums that we paid to buy to close, was negative. This table is showing us the cumulative monthly summary. Therefore, month 1 is exactly the same, obviously, in both cases. Month 2 could be month 1 plus month 2, a cumulative. Month 3 is going to be whatever happened that month and the 2 months before, and so on and so forth. Therefore, in total, in calls, even though month 2 was negative, in total now we've collected nearly 14,000 of call income in this account. All the options together, 487,000 on an investment of 1 million. But remember that we only have the 1 million for half the time, because for 3 months we were trading on an investment of 500,000, and it was not until month 4 in August that we had the full use of 1,000. Therefore, the profits are diluted down. This is the total amount of money that we have used for buying shares. However, because we sold some, that's why when we add these two together, we come to this 686,000. This is what we paid in the past to buy the shares. This is the price as of today, value now, and the difference between both is what we called price drag. We had also mentioned that this graph is similar to the one below, it's just that it's breakdown into the different industries that we have. In blue is the price that we paid to buy the shares, and the orange is the price now. Up until now, we have sold puts for a value of 2.1 million, meaning that if all the puts had been assigned to us, we would have needed 2.1 million to buy all those shares. In reality, what happens is that not all those shares get put to us. Some are pushed forward, some are accepted, and some expire worthless. The amount of money that we have invested so far in buying the shares, in allowing the puts being put to us, is being 756,000, which is 35% of this total amount here. How much money have we used to buy to open leads, buy to open puts, or buy to close positions because they were in profit and we got to keep the premium? 7,439, which is 3.33%. If we add these two values together, we come up with a 38.91%, and that helps us to predict what's going to happen in the future. And we'll talk about that in the video about the future.